Welcome back to Nasdaq Live. I'm Vanita Singla. Joining us today is Mr. Ketul, Associate Portfolio Manager at EQC Funds. Hi, Ketul.
Hey, Vanita, how are you?
Good, and yourself?
Pretty good, thank you.
So all this red behind us today, what's driving the markets today?
The markets have been in this mode since the end of the EU leaders meeting we saw over the weekend, and it's just a continuation of the trend. The S&P has ended in red for all the days this week, and it is because of we didn't come up with anything concrete with the EU leaders meeting. Some people were of the opinion that the Fed's announcement yesterday was slightly negative. I don't think there was anything over there that we did not expect. We were not expecting anything in terms of QE3 from the Fed. They did not make any announcement. They pretty much said they're going to continue what they're doing right now. So I think Fed was overall neutral, and it's just a continuation of the European crisis not being solved or nothing concrete coming out from the meeting last week.
Right, and how long do you think investors will continue to focus on the Eurozone situation?
The Eurozone, as I see it, I think you can divide the whole issue into two parts. One is the short-term liquidity issue, and the second part is the long-term debt issue. The short-term liquidity issue can be helped by various methods. One of the things that the global central banks coordinated and induced a lot of liquidity into the markets on, I think it was 1st or 2nd of December, and that rallied the markets for some time because that was a short-term fix. And then the EU leaders meeting over the weekend was supposed to help solve the long-term issue. I think the outcome of the meeting last week was at best useless. And they did not say anything concrete. They came up with the same stuff that they have said in the previous meetings and left it to another meeting. So I think that was very negative for the markets. And as long as you don't fix both the issues, the European crisis will continue. We might see sometime liquidity in focus, sometime the long-term debt issue into focus, but it's going to be a play between those two, and I don't see a solution to it in the near future at least.
So when do you see a turnaround with the situation in Europe?
The turnaround, as I see it, the only way there could be a turnaround is if you fix the long-term issue, because short-term liquidity issue, it's being fixed by various methods. The long-term issue is that Germany needs to actually bail the rest of the European countries out. It's as simple as that. Now Germany has to find a politically palatable solution to this, and one way to do is by obviously printing European bonds. I think just the ECB goes into printing mode and starts bailing out nations. Germany would not like that, and Germany wants something in return for that. One of the things that it wants is a more tighter fiscal union. So I think it's a clash between countries not willing to give up their fiscal independence versus Germany wanting to get more out of this crisis and trying to get more fiscal union within Europe. So it's a clash between the two. A lot of it has to do with politics. There are new governments in 3 countries over there. So I think all of that put together, it's a very fluid situation.
Right. Speaking of new governments, Italy paid an average euro high yield of 6.47% at its 5-year bond auction this morning. What does this say about Italy's ability to continue raising funds?
I think Italy is on a downward slide. I think the last bond auction they paid 6.29, if I'm not wrong. This bond auction they paid 6.47, and the yield keeps on going higher and higher. Italy can sustain this for some time, but it's not a path you want to go. You want to see that yield coming down. That is, and this is with the help of the ECB doing the bond buying and supporting the bond market. ECB cannot buy in the primary market, but they do support the secondary market. So I think even with that, if the Italian yields are not going any lower, it's a dangerous track that they are on.
And how does Italy's bond auction this morning compare with Germany's?
Today is a typical risk-off day. Germany being on the risk-off side, German yields went lower, and Italian yields being on the risk-on side, the Italian yields went higher. So I think that was what was at play, and it's a pretty straightforward flight to safety.
All right, and the euro is at its lowest level in nearly a year, below $1.30. What direction do you see the euro going in?
I'm not a currency expert, but based on the macro fundamentals that I see, and solutions to the European crisis that we see. One is that chaotic breakup of the euro, in which case the euro currency is going to go down significantly. The other option is that ECB starts printing money very quickly to save these countries. And in that case, that also leads to a lower valuation of the euro. So from whatever perspective you look at, there is no particular scenario where you can see the euro going a lot higher from here. So I think the risk to the chances of an upside are low versus the chances of a downside on the euro are quite high.
And how will that impact the U.S. dollar in the markets here at home?
U.S. dollars always gains versus the euro whenever it's a pair trade. If one currency loses, the other currency gains value, right? So I think when you compare it to the euro, the U.S. dollar always gains.
And as you said, the U.S. central bankers did not propose a QE3 yesterday or a change in the interest rate. How does all that impact the U.S. economy?
The U.S. economy, I think what the central bank is doing is it's doing all that it can right now. QE3 was probably not required at this point. Two reasons. One is the inflation in U.S. is catching up. There is no chance of deflation. Last time we had QE2 and QE1 because there was a high probability of U.S. getting into a deflationary mode. Now, since deflation is out of the equation and inflation is getting close to where the Fed is comfortable, from that perspective, QE3 was not required. On the other hand, we have seen some good macroeconomic numbers from the U.S. economy also. So, if we leave the Europe situation aside, there was no reason for the Fed to go into a QE3 mode. And if you consider the Europe situation, Fed is mostly reactive. It's not proactive. Most of the times, Fed takes a step after it sees some turmoil in the market or some major shock. And so far, we haven't seen that major shock which will make the Fed to move such a huge, QE3 type of announcement. So I think the QE3 announcement, which didn't happen yesterday, was quite in line with our expectations.
And what are the expectations for the U.S. 30-year bond auction later today?
It's the same as Germany. The yields will go lower. It's a flight to safety. U.S. dollar is stronger. It's a risk-off day, so no changes over there. The yield should go lower.
All right, let's talk about oil. OPEC has agreed to cap the group's crude oil production at 30 million barrels a day. What does this mean for global supply and demand?
Global supply and demand on the oil side, I think there is sufficient supply of oil. On the demand side, there are issues. There are a lot of expectations that various regions in the world might go into a recession. So given that, the demand might slow down compared to what I think the EIA came up with a reduction in growth of oil demand yesterday or the day before yesterday, I believe. So the demand is on the downslide. Supply, even if it remains constant, I think that should put a downward pressure on the oil prices. So OPEC deciding not to increase the supply and cap it at where it is right now, I think it's in line with what they expect.
So even though the White House has approved the extension of the payroll tax cut, there's quite a bit of tension between the Republicans and Democrats.
Yes. The payroll tax cut, the Republicans approved it in the House, but to that bill there were a lot of other things that were attached which were not politically palatable for the Democratic administration. One of the things was the Keystone XL pipeline. Now that has been a big environmental issue for the Obama government. And the other thing was a cut in spending for the healthcare law, which was already put into place last year, and now this particular bill proposes a cut to it. So it was not just a payroll tax cut thing. There were a lot of other strings that were attached that came along with the payroll tax cut, and that is why I think the Obama administration was opposing it.
All right, thank you so much, Ketul.